Hello everyone, and welcome to Chapter 3, Episode 1. In Chapter 3, we are going to kind of review what we've already talked about, but add a little deeper insight to the relationships between the financial statements that we have discussed, and also add one more. Let me get my picture out of the way here. Here you have a set of financial statements beginning with a balance sheet at the end of year 7 as of December 31st, 20X7. And it tells you the status of the accounting equation, the assets, liabilities, and owner's equity at the end of year 7. And then as we get into year 8, we have an income statement. Remember, another name for the income statement is a statement of operations. It focuses on the operations that happen throughout the period of time that we're discussing, in this case, year 8. So from January 1st to December 31st of year 8, these are the revenues and the expenses that were incurred. At the end of the year, the net income, revenues minus expenses, the net income is added to the beginning balance of the retained earnings. Remember, that's the retained earnings that we had at the end of the previous year. We add the net income and subtract the dividends, and that tells us the new balance in retained earnings we have at the end of this year, the end of year 8. So the balance sheets tell us the status at either point in time. But the income statement focuses on what happened throughout this time period, the operations that we had. And then along with the statement of retained earnings, it kind of explains how we got from the beginning retained earnings to the balance at the end of year 8. Another financial statement that we have not discussed, and I'm just going to mention it to you. I'm not going to test you over it, but it is briefly introduced in Chapter 3. It's called the Statement of Cash Flows. The Statement of Cash Flows simply summarizes the cash collections and the cash payments that we had throughout the year. And it classifies them according to whether or not the cash flows related to the day-to-day operating activities, investing activities like buy and long-term investments in equipment or buildings or something like that, or if it related to financing activities, getting new cash from lenders or from stockholders, or maybe paying off loans. But anyway, the statement of cash flows summarizes the cash flows, the cash collections, and the cash payments that happen throughout the year. Contrast that with what we're looking at on the income statement. The income statement focuses on activity, on what we did, operations. Remember, statement of operations. So how much work did we do? That's what the revenue number tells us. This is how much work we provided to customers throughout the year. And in providing those services, we incurred expenses too. But the focus is on activity, regardless of when the money changed hands. So the statement of cash flows captures the cash collections and cash payments, and the income statement, based on the accrual basis of accounting, focuses on when we did the work and matches against that the expenses for resources that expired during the period. So the statement of cash flows and the income statement are like two sides of the same coin. The income statement focuses on when the activity happened, and the statement of cash flows focuses on the cash collections and the cash payments. So this is already kind of been involved in how we have recorded transactions. So let me just kind of summarize what we've already done because of these timing differences. Sometimes cash flows happen first, and then the work is done or the activity happens. For example, think about this, what's going on in the blue here. Sometimes customers pay us in advance, and when they pay us, we debit cash and we credit a liability. We call it unearned revenue. So we have a liability because we owe them work. We've already collected the money, but we haven't done the work yet. Well, if you get to the end of the year, you need to update the fact that, hey, some of this work has been done. And so you would reduce the liability for the work that you've already done and record a revenue for that portion that you've already earned. So again, the cash was collected first, but we didn't record the revenue until we actually did the work. Sometimes we're not collecting money, we're paying the money. And we pay for something on the front end before the expense has been incurred. For example, maybe we pay for rent in advance. So we credit cash and we debit prepaid rent. Or maybe we purchase equipment. So we credit cash and we debit an equipment. Well, when you get to the end of the year, you need to make sure that you have properly updated how much of that asset has expired. So like for prepaid rent, we would credit the prepaid rent and debit rent expense. Or if we're talking about the wear and tear on equipment, we would credit the equipment and debit depreciation expense. So these are all things that we've been doing from day one. We're just kind of summarizing that and adding a little different perspective to it. These situations where the money changes hands first and later the activity happens, we call these deferrals. In other words, when the money is being paid, we don't record the income effect yet. We defer or put off recording the income effect until the activity happens. So we call these deferrals. You don't need to know that word, I'm just telling you. Sometimes we have the reverse situation. An activity happens first, and then the money changes hands later. For example, if we do work for a customer, anytime we do work, we record the revenue. And so if you have done work for customers and have not been paid yet, at the end of the year, you need to update the fact that, hey, we've done this work and we haven't been paid, so we would debit accounts receivable. These are called accruals. We are accruing that revenue. Again, you don't need to know that word, I'm just telling you. But kind of in a general sense, we are accruing the receivable there for the work that's already been done. And then later, we would debit cash and credit the receivable when we collected the money. Again, we've already been doing that as well, but just to kind of add focus to the fact that sometimes the income effect happens first, and then we collect the money. That can also happen when we're talking about expenses, and this in the green here, we have not discussed that yet. Sometimes we incur an expense, and if we get to the end of the year and we owe any money that has for things that have already happened, then we would need to record an entry to update the numbers to be reported on the financial statements. A good example of that would be wages. Sometimes, what we've been doing is recording wages on payday. Well, what happens if the end of the year comes between paydays? So on December 31st, we need to record the fact that maybe we've already incurred a liability to our employees, but we hadn't paid it yet. And so we want to go ahead and update that. And then later, on payday, we would make the payment. So let's look at an example of that with numbers. Okay, suppose we have a 5-day work week. Payday is every Friday. And on every Friday, our payroll adds up to about $20,000. So that's about $4,000 a day for a 5-day work week. So on a typical Friday, we would debit wages expense and credit cash for $20,000. So every Friday, we would be debiting wages expense for $20,000. Let me put 3 of them in there. So that happens every Friday. And of course, we would have a whole bunch of Fridays throughout the year. So we would have quite a few debits building up in that account. But I'm just going to put 3 for example purposes. And suppose we get over here to the last week of the year. And so we had payday on Friday, and now Monday and Tuesday are the last 2 days of the year, and we're going to make financial statements as of December 31st. Now we're not going to have payday until the next Friday, but when we put together the financial statements, we want those financial statements to be up to date all the way through December 31st. So we need to make an adjusting journal entry to update the numbers before we make the financial statements. Monday and Tuesday have already happened. If we were to stop right now, we owe our employees $8,000 for Monday and Tuesday. So we're going to go ahead and record an adjusting journal entry. These end of year journal entries to bring the numbers up to date are called adjusting journal entries. And we're going to debit wages expense for those 2 days, $8,000, and credit wages payable. So when I record that, the debit of $8,000 goes to wages expense, and the credit of $8,000 goes to wages payable. So when it comes time to make the financial statements, we would add up, balance the accounts, and the $68,000 of wages expense would go to the income statement, and the $8,000 of wages payable would be reported as a liability on the balance sheet. So now those 2 financial statements are up to date all the way through Tuesday of December 31st. After we make the financial statements, remember the very last thing we do are the closing entries that we talked about in Chapter 2. The closing entries are kind of like the stopwatch where you set the temporary accounts back to 0. Well, in this example, the temporary account is wages expense. So we would prepare closing entries to zero out the wages expense along with all of the other temporary accounts and transfer that information to retained earnings. Now we don't erase it, we do the closing entries, but for our purposes, I'm just going to delete it to set that back to 0. So we did the closing entries at the end of the year. Then we come back to work and we work Wednesday, Thursday, and Friday of the new year. And now we have a new payday, and we're going to pay $20,000 for the last week. But sometimes when we look at this, folks get a little confused and they think we're just going to be making a payment of $12,000. Well, that would not make your employees very happy because they have not been paid for Monday and Tuesday. We just recorded a liability for that back on Tuesday. Anyway, now it's Friday. We're going to pay our employees credit cash for $20,000, and the debits, $8,000 of that is to take care of the liability that we had recorded at the end of the previous period, and then the remaining debit of $12,000 would go to wages expense, and that represents the first 3 days of wages in the brand new year. Remember, we set that back to 0 through the closing entries, so we're starting fresh. And so for Wednesday, Thursday, and Friday, the wages expense in the new year is $12,000. Okay, so that's how we record wages. And let's look at one more example of that. So here I have a different example. We have a weekly payroll of $15,000. So every Friday, our payroll is $15,000. So that means on every Friday, we would debit wages expense and credit cash for $15,000. So suppose I did that, $15,000. So I'll just do 3 of those again. But again, the wages expense would be recorded every Friday throughout the year. What's different when we get to the end of the year is December 31st falls between paydays. So in this case, the 31st is on Wednesday. So we've had 3 days of wages that have already been incurred, but we're not going to pay for those until payday. But we are going to prepare financial statements as of the December 31st. We want those financial statements to be up to date. So for those 3 days, we're going to debit wages expense, $9,000. I'll post that to the ledger. And we're going to credit wages payable for $9,000. So let me balance up the accounts. Wages expense adds up to $54,000. And that $54,000 of expense would go to the income statement, covering the entire year. But on the balance sheet, we would have a wages payable of only $9,000. That's all we owe the employees right now. If we were to stop right now, we still owe them $9,000 for the 3 days that they've already worked. So by recording this adjusting journal entry, the financial statements as of December 31st are up to date, the wages expense on the income statement, and the liability for wages payable on the balance sheet. After we make the financial statements, we do the closing entries. The only thing that closes are the temporary accounts, in this case, wages expense. So that goes back to 0. Then the brand new year starts. After working for a couple of days, now we have another payday. So we're going to pay cash of $15,000, credit to the cash account. The first part of that is to take care of the liability, debit wages payable for $9,000. That's the liability we created back on Wednesday. And then the rest of the debit, $6,000, goes to wages expense, and that represents the first 2 days of the new year. So wages expense, which was set back to 0, is now starting to accumulate wages for the new year. So that's how the adjusting entry at the end of the year related to wages is recorded, and then we would take care of that the split between wages payable and wages expense at the next payday. Okay, that is enough for that video, and please do some practice problems. This adjustment for wages tends to be one of the problems that is most missed on the exam, so I would encourage you to practice that on the homework.